Salutations, 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 everybody. For those who don't know who I am, my name is Timothy Lee Rogers Sr., and I'd like to welcome you to another episode of Learning to Trade Futures with yours truly, Lil Timmy Rogers. Again, welcome to another episode of Learning to Trade Futures with Lil Timmy Rogers. This is Part-2 of the series. Now, if you have not watched Part 1 or the intro video, I please ask that you will go here. I think I got the card position right now, but please go here and watch the intro and Part 1, and then come back here and continue on with Part 2. Go ahead. Go watch them. Go watch the videos. I know you ain't go watch it if you ain't started yet. Let's get into it, man. Now, learning to trade futures with Lil Timmy Rogers, Part 2, if you will. Now, before we get into, I forgot to tell y'all what this episode was about. This episode is about, we're going to discuss the elements of a trade. Now, let me go back to the camera for a second. In this episode, I want to preface this, that in order to do the homework for this episode, you will need to understand certain ICT concepts. You will need to understand, matter of fact, I think I'll put a card here for my ICT lingo playlist, but you will need to be able to identify an order block. You will need to be able to identify imbalances such as fair value gaps or liquidity voids. You will need to understand what equilibrium is, and you will need to understand where buy stops and sell stops rest, where the liquidity pools are. Now, the buy stops and sell stops isn't hard, but when you hear me talk about liquidity pools, I'm talking about the pools of buy stops and sell stops. But you will need to understand those ICT concepts in order to do the homework, and for a lot of the stuff that I say to make sense in this video. But like I said, you don't have to trade ICT concepts, but understanding ICT concepts will help, because every last one of these slides, these are just screenshots straight from Michael's core content, and I'm just utilizing this because those are the concepts that I trade. And you, again, all of these slides are straight from his core content, and you are welcome to go to his core content and get it from the horse's mouth on your own. Now, let's get back into the video, shall we? Now, when it comes to price, when it comes to the market, when it comes to anything you think about them, anytime you think about the market, should I say, you know something's going on behind the scene. You don't know what's moving the market. You just know something behind the market, something behind the scene is moving the market. You got a vague idea. Can't really make it out, right? The more you learn, be it from ICT, be it from any other concept you learn, trade, it starts to get clearer, right? Everything starts to get a little bit clearer. And at first glance, the mistake that myself and many other retail traders make, right? We start to learn that there's smart money and there's uninformed money. The thing that the mistake that I made was thinking that if you look over here, let me turn my fancy dancy on. Now, I was thinking that smart money was like the hedge funds, the big boys, and the speculators or the uninformed money was just retail traders like myself, right? And when we were kids, when I was a kid, they had these little contraptions called big wheels. And when you sat on the big wheel in the front was responsible for moving that vehicle, if you will, right? So I always thought that this big wheel was what was moving the market, right? And the small area of smart money, then the big area of retail traders. That's what I thought, right? But once you start understanding the market efficiency paradigm, right, you start to understand that there's a relationship between the smart money and the uninformed money, right? The smart money and the speculative money, right? And then you start to understand that this isn't just quote unquote retail traders, and this over here are hedge fund managers and big fund managers. No, 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 no. You learn that the smart money is controlling it. The smart money is the one that's moving the machine. Once you start understanding the relationship between the smart money and the speculative uninformed money, that's when you realize that everybody in this circle over here is the liquidity. The smart money, the price is delivered to engineer efficiency for the smart money. Everybody in this circle, hedge fund managers, retail Rick like myself, Risky Randy, Reckless Rachel, everybody is in this big circle together, and we are the liquidity for the smart money. Now, you have quote unquote retail traders that's in this area of smart money because they have figured out the market efficiency paradigm, as Michael likes to call it. They figured out that everybody in this circle is the liquidity for everybody in this circle. Once I figured that out, once that clicked, I said, aha! So I can trade with my little bit of dough with the mindset of those in this circle. So shout out Jesse Rogers, aka Casper. Like he always say, if you can't see the liquidity, you are the liquidity, right? Once you figure that out, I figured it out by using the concepts that ICT teach. But once you figure that out, everybody in this circle, hedge fund managers and all, you're just the liquidity for everybody in this circle. Now, Tim, you're saying a whole lot, but how is that going? How am I going to figure that out? You're going to figure that out by understanding the elements of a trade setup, right? It's as simple as this. It doesn't get any simpler than this, right? These are the elements of a trade setup. Now, you can devise many models, you can devise many strategies, you can make it as complex or as simple as you want. But as long as you understand these elements of a trade setup, you have all you need to know to master the market efficiency paradigm. And you can be in this small circle of smart money seeking the ones in this big circle, the liquidity. Now, what's the elements of a trade setup, right? You got 4 elements / context or frameworks surrounding the idea, right? And then you have institutional PD arrays. Michael calls them PD arrays, right? You have reference points and you have imbalances. But for all intents and purposes, in this, we're calling all of them reference points right now because these framework surrounding the ideas refer to these PD arrays. That's why we're calling them all reference points in this subject. Now, we have expansion, we have retracement, we have reversal, and we have consolidation. These are all the conditions that price will be in the market. You're going to have times of expansion, you're going to have times of retracement, you're going to have times of reversal, you're going to have times of consolidation. That's all price going to do. That's all price can do in the market. It can expand up or down, it can retrace up or down, it can reverse up or down, and it can go side to side, consolidate, chop in a small range. That's all price can do. Now, the reference points or the PD arrays that these different frameworks refer to are order blocks, imbalances in the form of fair value gaps and liquidity voids, liquidity pools, like I say, the stop losses, the stops, they're running stops, and equilibrium, right? Expansion refers to order blocks. Retracements refer to imbalances. Reversals, they happen at liquidity pools when they run stops. Consolidations, they refer to equilibrium. So each context or framework refers to a different PD array. So once you figure out what state the market is in, expansion, retracement, reversal, consolidation, you can then start to use PD arrays. You know which PD arrays, should I say, to start to look for to try to plan your trade setup. Now, before we get into tying the PD arrays to the different market states, let's look at the relationship of the market states using what I like to call IPDA's behavior, if you will. Now, if you don't know what IPDA is, go check out Michael's core content to explain what IPDA is. But this is IPDA's behavior. Price will always move in two different manners when it comes to price delivery, right? When it comes to price delivery, you have four elements, four contexts, four frameworks, right? But the way they work together is in the sense of price delivery. Price will always consolidate, expand, retrace, then deliver, or it will consolidate, expand, reverse, retrace, and then deliver. So only two different ways price is going to move, right? This was game changing for me when I figured this out, going through Michael's content. Again, way number one, price is going to deliver, right? It can consolidate, go into expansion, go into retracement, and then deliver price. Or two, it will consolidate, go into expansion, go into a reversal, then a retracement, and then deliver price. I don't know how many fingers I had up and how many I was supposed to, but just bear with me. Now, let's get into it. Remember, I call it IPDA's behavior, the way the algorithm works. That's how the algorithm works to deliver price efficiently. First, context, right? Expansion is always going to be tied to an order block. Well, what is expansion, Tim? Expansion, read with me, if you will. What is expansion? Expansion is when price moves quickly from a level of equilibrium, right? Meaning it's consolidating around equilibrium of that consolidation, then price takes off. We like to call it the pang-ow. Get a pang-ow to the upside, pang-ow to the downside. That's expansion, right? Expansion is always tied to an order block, right? What is the importance of this? When price leaves a level quickly, this indicates a willingness on the part of the market makers to reveal their intended repricing model. Meaning, how are they going to do it, right? So, again, expansion is always tied to an order block, right? What do you look for in price? The order block the market makers leave at or near equilibrium. As I said, the expansion is always going to be tied to an order block. And like I said, you need to understand what an order block is. So please go back and either watch my ICT Lingo Explained content or go to Michael's core content and find out what an order block is. Moving right on. Let's see how it looks in price action. Right? So here we are. Draw your attention here to this area of consolidation, right? The equilibrium is the 50%, the halfway in between the highest high and the lowest low of that consolidation area, right? That's your equilibrium for the consolidation area, right? So when price leaves equilibrium aggressively, like it does here, pang, right? Here is it left to the upside, so it left a bullish order block right here near at or near the equilibrium. The bullish order block at or near equilibrium is the area that you look for the order block in the case of this expansion right here. You can start to frame your trade setup based off of the expansion here around where is the order block, right? Where is the order? You can start to shape your trade setup. You can start to look for your trade setup. You can start to, you get what I'm saying, right? So expansion is always tied to an order block. So remember, when price leaves equilibrium quickly, the order block that the market maker leaves at or near equilibrium is the key to forming your trade setup for that particular model, right? Tracking? Did I lose anybody? I probably did, but run it back a couple times. You'll get it. You'll get it. Now, let's talk about retracement, right? Retracement is always linked to imbalances, right? Like liquidity, voids, fair value gaps, imbalances. It's some kind of imbalance in price. The retracement is linked to that. Now, what is a retracement? Retracement is when price moves back inside the recently created price range, right? So when you get expansion to the upside or downside, it's creating a new price range, right? So retracement is when price moves back inside that recently created price range that was left behind after the expansion, right? So what's the importance of this? When price returns inside a recent price range, this indicates a willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. Again, it's going to be looking for fair value gaps, liquidity voids, any type of imbalance in the recently created price range made by what? The expansion. When it expands out, if it leaves any imbalances and it starts to retrace back into there, that is the market maker, aka IPTA, aka the algo. That's the market maker showing a willingness to reprice back into those levels. Why? To take care of those inefficiencies, right? What do you look for? The fair value gaps and the voids. You're looking for fair value. You're looking for any type of imbalance, like a fair value gap, a liquidity void, a volume imbalance. You're looking for any type of imbalance inside that price leg, that price range, that whatever you want to call it after the expansion. That's what you're looking for, the imbalances. Now, let's see what it looked like in price. Now, before we go anywhere, you see here how this says liquidity void. Just ignore that. Back in 2016, when Michael created this, right? He came out later and said the reason why he was calling this imbalance here, liquidity voids, is because the people he was trying to teach on baby pips refused to understand that this was not a liquidity void and this was just an imbalance. So he just didn't want to argue, and he just said, okay, this is a liquidity void. But a liquidity void is a full gap where there's no price at all, no candle, no wick. That's a liquidity void, right? When it's just big candles like this right here without delivery on the opposite side, it's just a form of an imbalance. Now, let's look at this here. Here we go. We have this big expansion, right, to the downside here, right? when price starts to retrace or pull back into this range from this expansion, see this fair value gap here, this fair value gap here, right? All the way back up to this bearish order block right there, right? Remember the order block from the last one? The order block is tied to the expansion. So you got this bearish order block, you got these imbalances in here. So it's retracing back up to offer delivery on the opposite side. You expanded to the downside. You didn't have any buy side delivery in this continuous down move right here. So price retraced back into that range, this new range created from the expansion. And there you go. Retracements are tied to imbalances, right? Retracements are tied. So it's retracing to rebalance this inefficiency here. And if you look over there, it stopped where? At the order block, the reference point that the algorithm left, like, hey, this is where I started. This is where I need to stop. Came back up, repriced all of this, hit the order block, and sold off. It's starting to tie together, isn't it? It's starting to tie together, isn't it? Let's get into the reversals, right? Now, reversals are tied with liquidity pools, right? Reversals are tied with liquidity pools. What is a reversal? Reversal is when price moves the opposite direction that current direction has taken, meaning it turns around. It does a 180, right? What is the importance, right? When price reverses direction, it indicates the market makers have ran a level of stops and a significant move should unfold in the new direction, right? So when you run stops and you soak up enough stops to make it the happy, it's going to do a 180 and go in the other direction. That's a reversal, right? What do you look for, right? The liquidity pool just above an old price high and just below an old price low. So you look for swing lows and swing highs, right? Significant swing lows and swing highs. It's resting below every one, but it just depends on the time frame you're looking at. So when you get to swing lows and swing highs and it soak up enough liquidity, it'll give you a reversal, right? Let's look at it in price action, right? So if you see here, when price came up to these old highs over here, it got up there and it soaked up enough liquidity and then it reversed, right? Price went up into the liquidity pool, soaked it up, then reversed, right? This old low right here, price went down below that old low. This one here, it didn't even stay long. 2 wicks, 1, 2, and reversed, right? Price came down to an old low, then reversed, right? Here we go here. Price, this is the old high. Price got above that old high, stayed up there for a little while, soaking up liquidity, then reversed. You get the picture, right? Now, consolidation, right? Consolidation is always linked to equilibrium. Again, equilibrium is 50%, the halfway point in between the highest high and the lowest low, right? So consolidation is always tied to equilibrium. What is consolidation, right? Consolidation is when price moves inside a clear trading range and shows no willingness to move significantly higher or lower. It's just moving sideways. It come this high, then go that low, then go this high, then go that low, then go that high, then go this low, then go. It's just a clear defined range. It is not trying to move outside of that range. What's the importance? When price consolidates, it indicates the market makers are allowing orders to build on both sides of the market. Expect a new expansion near term, right? See how everything's starting to tie together? It's starting to make sense. Yeah. What do you look for in price, right? The impulse swing and price away from the equilibrium price level that is found exactly in the halfway point of the consolidation range. Let's go look at it in price, right? So see he has a Fibonacci tool that's running on here, and then right there, right, is the equilibrium line right there, right? Because he has anchored here on the body of this candle, and he has it anchored there on the body of that candle, right? That's where he has it anchored on the bodies. He's ignoring the wicks. Some people include the wicks. Some people ignore the wicks. Some people look at it as, hey, the wicks do the damage, the body tell the story, so they anchor it on the highest body and the lowest body. Some people say include the wicks, so they'll anchor it however you want to anchor yours. It's up to you. I ain't here to talk about how to anchor the Fibonacci tool. Here to talk about the consolidation. So if you look here, this is your equilibrium right here, right? This is your equilibrium right here. And then what do you look for in price, right? As we came up, we made this high and we swung back down, made that low, high, low, high, low. You see, we have a defined range. Price is not showing a willingness to break above this candle's body, right? We wicked below it a little, but all the bodies are staying inside. It's not showing a willingness to leave this area, right? And halfway in between the highest point and the lowest point, that's your equilibrium. Now look at what price does at the equilibrium. Every time it gets to equilibrium, it took off to the bottom, right? Came back to equilibrium, took off to the top, right? Came back to equilibrium, took off, back to it, stayed there a little bit, took off, back to it. So you got these, right? Impulse swings, right? Impulse swings away from the 50% point. See, take off, come back to it. Take off, come back to it. Every time it gets to equilibrium, you're seeing these small impulse swings leaving that area, but drawing back to it, right? That's your equilibrium point. Whatever point that is, you can identify it by either running the Fibonacci and looking at the 50% price, or if you don't want to run your Fib tool, you just look at what price is the impulse swings coming in at, right? And that is your last condition or framework. Now let's go back and talk about the homework that I didn't talk about previously. For expansion, since we had homework the last time, and we went through and we marked out the open, high, low, and close for the day, then the open, high, low, and close for the New York session, right? Hopefully you did your homework. Now, what I want you to do, I want you to look through price, right? I want you to look through price. You pick a time frame. You can pick the I like to do stuff on the hourly. You know, the lower the time frame, the more PD arrays you're going to see. The hourly time frame, I like to do the hourly because it gives you a good, overview of price. At the same time, giving you a good amount of PD arrays to see. But pick whatever time frame you want, but go through price, look for times when price consolidated and then expanded, and then look for and identify the order block that was created when price expanded, right? It can be to the upside, to the downside, but go through and do the work. Do the work. Do it for real, right? For retracements, right? For retracements, go back through time and see when price, expanded, right? And then see when price retraced back in, and what did it retrace back to? Did it go back to a fair value gap? Did it go back to a liquidity void, meaning a full gap? What did price retrace back to? Right? When it expanded down, what did it retrace back to? See the heavy displacement, what did it retrace back to? Go back through the price and look at this, right? Same thing with reversals, right? When price you can look at whatever time frame you want. Like I say, I like to look at the hourly time frame, but identify when price reversed, right? Look at when price made a sharp turn, like how it came down here, made a sharp turn. Once you look at how price made that sharp turn, look back to see what old high or what old low it took out before making that turn, right? And then go through and start to, just identify when it did. We're gonna get into, right now, just get your eye used to seeing it. This is like the building blocks. Just do the work. I know you might be thinking, Tim, that's so remedial. Anybody can see. Go do the work. Trust me. Go do the work. Right? And then for consolidations, look for areas of consolidation. And I like to use the fib tool. Run the fib tool from the highest high to the lowest low of the consolidation. You can see the consolidation ranges. It's in hindsight, so it make it easy to run the fib tool. I like to run it from the wicks, from the highest wick to the lowest wick. You can do the highest body to the lowest body in the consolidation. However you choose to run your. Now, if it's a real outlandish wick like this one right here, I tend to ignore those. Right? I tend to ignore those. Like in this time frame here, I would go from that wick there to that wick there. That's how I would run the fib on this. When it's a crazy long wick like this, I ignore those. Those are like some kind of stop hunt, some kind of news, something, right? So choose wicks, bodies. I don't care how you do it, but that's your homework. Now, how far back in time do you want to go? Here's a little recommendation from Michael himself. When you're, creating your logs for price, if you're doing a daily chart, you know what I'm saying, no less than, go back 12 months, no less than 9 months of price data in the window when you're looking at it, right? If you're doing 4-hour charts, do at least 3 months of data in the window when you're looking through it. If you're doing 60-minute hourly candles, like I say, do at least 3 weeks of data in the window, right? Close to a month. If I said 3 weeks, that's 3 months. I don't remember what I said. Now, if you're doing 15-minute charts, do like 3 or 4 days in the window, like a week in the window, right? So those are some recommendations on time. And if you want to go through and do this homework that he had also, you're welcome to it, but you're going to need to know about like kill zones and stuff like that to do all of that homework. But those are some recommendations on how much data to put into your chart when you're doing it. And remember, on TradingView, how to save your charts and all of that. We're not going to get into that in this video, but that's the end of this presentation. And again, I'd like to thank you for tuning in to another episode of Learning to Trade Futures with yours truly, Lil Timmy Rogers. And I see y'all in the next one, man. Gone. Yeah.